Welcome, everyone. We're so glad you can join us for this on-demand Inflation and Rising Interest Rates webinar hosted by JFL Total Wealth Management. June 2022 has seen continued market volatility and the official start of a bear market. High inflation has stuck around, prompting the Federal Reserve to raise interest rates again with the biggest single rate hike since 1994. But what does this mean for you? Today, JFL will review how the rising interest rates will impact you and what you can do to protect your finances. We'll also look at historical data to see if the economy is headed for a recession. Without further ado, let's introduce today's panelists. Jeanne Kane has an MBA from Duke University and is a certified financial planner. She has extensive experience with analyzing and managing our private clients' portfolios and with developing comprehensive financial plans. Jerry Lynch is a certified financial planner and has been an independent financial advisor for 25 years, working in the financial industry for more than 30. Welcome.
Welcome, everyone.
Welcome.
All right, Jeanne, do you want to get us started with today's agenda?
Absolutely. Thanks, Gretchen. So for today, we're going to share a couple different things. First, we'll go over an economic snapshot, and then we'll share our thoughts on what you can do today given current market conditions. So let's jump right in. So the I word, or inflation, that has continued to rear its ugly head. And the U.S.'s annual inflation has stayed near a 4-decade high, rising to 8.6% in May from 8.3% in April, despite hopes that we had reached a peak. And why is it happening? Well, strong demand. Consumers are continuing to spend. Early in the pandemic, we were all stuck at home and we were buying stuff online. Now, low unemployment rates have allowed people to take new jobs and make more money. And these factors have increased bank account balances and allowed families to buy more stuff. And couple that with too few goods. Factory shutdowns tied to the pandemic, global shipping backlogs, reduced production, those have snowballed into a parts and product shortage. And demand has outstripped supply of goods, and companies have been able to charge more without losing customers. And we add to that recent lockdowns in China due to the coronavirus. Those are really wreaking havoc on the supply chains again. And the war in the Ukraine, that is cutting into the world's supply of food and gas, which is pushing inflation higher and adding to the cost of other products and services. In fact, gas prices are averaging around $5 a gallon nationally, and that's up from $3 a year ago. And now we're also seeing service sector pressure. We're seeing inflation here as people are shifting their spending away from buying things and stuff and more towards experiences. Rents are climbing as Americans are competing for a limited number of apartments. Restaurants, airlines, hotel rooms all cost more because people are eager to travel and because fuel and labor costs are more expensive. In terms of rising interest rates, the Federal Reserve, they raised the federal funds rate in March, May, and June. And these were the first rate increases since 2018. And in June, rates were increased by 0.75%. And that was the sharpest increase since 1994. More interest rate increases are anticipated in July and also in October with the goal of helping tamp down on inflation. So how does this work? How do we fight inflation? Well, rising interest rates, that's one of the tools in the government's toolkit to really help curb inflation. And how does this happen? Well, if you raise interest rates, that makes it more expensive to borrow. If it's more expensive to borrow, there's likely going to be less people borrowing, or less companies borrowing. Less borrowing means less money flowing into the economy. And with less money flowing into the economy, that means there's less demand for goods and services. And that really helps try to balance out supply and demand, ultimately slowing down inflation. So how could rising interest rates affect you and your wallet? Well, if you're looking for a home, it's going to be more expensive for you to borrow. And interest rates, if they go up by 1 percentage point, you're going to pay $80 more per month per $100,000 that you borrow. And the average rate on a 30-year fixed rate mortgage, now that was 5.78% in mid-June. A year ago, that same rate was at 3.3%. And you really want to look at locking into that fixed rate mortgage. Adjustable rate mortgages are out there. They were really popular back during the time of the housing crisis, and people didn't understand exactly how those worked, which caused them to get into some trouble. So be very careful here if you're looking at something that has an adjustable rate associated with it. Now, higher interest rates generally will mean credit cards will charge a higher annual percentage rate, or an APR. Keep a close eye on your balance and the rate being charged by your credit card company, and even better, they'll pay off your credit card balance each month. Now, bond yields, as interest rates increase, the yield or the interest paid on new bonds increases. So this is good for the new bond purchaser, but not so good for those that are holding existing bonds. So think about the iPhone 14 and its launch in September. It has the latest technology with it, but Apple still has a lot of those iPhone 12s and 13s in stock. They can't charge the same premium so those older phones go on sale. That's really what's happening with bonds. Now, the 10-year Treasury note, those rates reached 3.48%. This is an 11-year high. And there's one area of bright spot that relates to bonds, and that's in I-bonds. Those are paying 9.62%, issued starting in May of this year. Now, I-bonds are issued by the U.S. Treasury, and they're designed to protect your money from losing value due to inflation. They're exempt from state and local income taxes, and there are restrictions on them, though, in terms of how much you can buy. Cashing out early can lead to some forfeiting a small portion of the interest earned. So just kind of be aware of some of the caveats as well. Now, in terms of student loans, federal subsidized and unsubsidized loans, they recently reset the rates for this coming school year. Now, those rates are scheduled to increase to nearly 5%. This past academic school year, the rates hovered around 3.75%. Now, private loans, those are going to vary by lender and your individual financial circumstances. But if you use these types of loans, you're likely to expect higher interest rates as well. Now, in terms of savings rates, here's another little silver lining out there. Because rates in your savings accounts and CD rates, those are starting to increase here as well. So let's talk a little bit about market volatility. So the stock market has been on track for the worst first half of the year since 1970. The S&P 500 has fallen 19.9% over the past 6 months, and the sell-off has been remarkably broad, with every sector except energy down this year. And the good news for investors, though, is that markets haven't always done poorly after suffering big losses in the first half of the year. In fact, history shows us they've done the opposite. When the S&P 500 has fallen at least 15% in the first 6 months of the year, as it did in 1932, 1939, 1940, 1962, and 1970, it rose an average of 24% in the second half of the year. And when we think about volatility, the stock market is generally what comes to mind. We're not thinking about the bond market. Bond markets are generally viewed as safer investments, especially bonds that are backed by the full face of the U.S. government. Well, in today's environment, we're seeing a rare occurrence where both U.S. stocks and U.S. bonds are down. And this happens really only about 8% of the time, so it's not very common. So now I'm going to shift this over to Jerry, who's going to talk a little bit more about market volatility and then what you can do as an investor.
Hello again. I'm going to go through a couple different things here today. Just real brief. If you take a look at the year-to-date numbers, the S&P is down slightly less than 20%. The NASDAQ is down slightly less than 30%. There's been a substantial drop in the market over the past, year to date. Now, also, if you look at the bond indexes, which Jeanne was just referencing just briefly ago, there has been a substantial drop in there as well, too. Now, those of you in our portfolios have seen less of a decline in the stock simply because we are more value-oriented than growth-oriented. The NASDAQ, I think, is more growth stocks. That's helped us basically buffer some of the impact of these things. On the bonds, mainly what we're looking to do is be short in the duration, higher in the quality. That's also helped us. So, I mean, if you just take a look at the corporate investment grade bond, they're down almost 15% year to date. Our bond portfolios are down substantially less than that. We're going to continue to take a look at what we're doing here and see if there's ways that we could add some more value going in towards the end of the year. Now, in terms of market volatility, one of my favorite people in investment is a gentleman named David Booth, who is the founder of a company called Dimensional Funds. For those of you in academia, the Chicago School of Business is named after him. His original board of directors has 3 Nobel laureates. 2 are still on the board of directors. The other person passed away. So his entire company is based on academia. And when I took a look at something he sent out yesterday, he had some very good points that I want to kind of reemphasize. Number one, why are we investing? What is the purpose of this money? What is the duration that we are looking for this money? Is this a 30-year plan or if this is a short plan? My general rule is if you need money in less than 5 years, you should have it in cash or a very conservative part of your portfolio. If you have a longer period of time, you can invest with a longer time frame. And I think that's what everybody here we're doing right now. Secondly, I think you got to take a look at the balance that you have in bonds and stocks to understand the potential pain that's associated with your investments. With every one of you who come into our office, one of the things we always bring out is our market volatility, basically saying that in a 2008 type situation, how would this portfolio work? And I think it's very important that we invest long-term within your pain threshold. So the way that we minimize the impact of those indexes that you just saw on the previous sheet is how much do we have in bonds and how much do we have in stocks? Now, and the third thing I would say that came from his email was that when I'm looking at this thing, the most important thing is control the controllables, meaning that I can't control the stock market. I cannot control what's happening out there with inflation. What I can control is what do I spend? And if there are ways that I could reduce it, that is something I could definitely control. And the other thing that I could do is control what I save on a systematic basis. Now, if I had a time machine and could go back in time, I would go back to 2000, to 9/11, to 2008, March 2020. And those were some of the best investment times that are out there. And when I'm looking at the stock market right now and the declines that they had, I see this as basically being a very good buying opportunity where we could get involved in things that we felt comfortable with a few months ago and buy them at a discount, which is really what you want to do long term. So one of the questions that people have is, what's a recession and how does this really impact me? And a lot of times what I try to do with these types of concepts is I relate it to myself and my family. So every January, the first thing I do is take a look at the credit card bills and see how much we spent along the holidays. And my immediate reaction is, I got to slow this thing up. I got to stop spending at this level because what we did in November and December is too high. I got to kind of cut it down. And with a recession, that's basically exactly the same thing, but on a big picture. So the first thing you see is negative gross domestic product, which in simplest terms is people are spending less. So if you take a look at what's going on, it's reasonable that a lot of companies and a lot of individuals, because of these situations, are going to slow up what they're spending on a systematic basis, just like I do every January. So this is part of the natural process. The second thing that could happen is that there's a chance for increases of unemployment. Historically, unemployment increases in a recession. I'm not sure how this is going to be impacted because I think there's still a lot of businesses out there that are dying to get people. You know, if you take a look at infrastructure, if you take a look at trucking and imports and just the supply chain areas that we have in the United States, these are still areas that are going to be high at a very good level. And the natural final result is that there probably will be a slowing of production. So if people are spending less and there's potential for unemployment to increase to a certain extent, it's reasonable that many of the businesses may be slowing down a little bit in terms of how much they're producing on a regular basis. But this is part of a natural a cycle within the market. You have a period of time where there's excessive spending, which we had in the past several years. And generally what happens is after that, there's a period of time that it slows down. And that's exactly what we're seeing right now. So in terms of what happens during a recession, and this is really taking a look at 2008 and what happened there, you were looking at a drop of the market of almost about 50%. Production dropped substantially, and the duration that you have was probably about 18 months. All right. I think 2008 versus today are very different because the biggest issue in 2008, in my mind, was that a lot of the banks were basically taking on loans and not capitalized correctly. Since then, there's been a lot of changes in regulations that have forced banks to be more financially stable. So I don't think we have that huge fundamental issue. I think the biggest thing that we're looking at is that we have high inflation, we have supply chain issues, and that there was a huge amount of spending over the past couple of years that is going to naturally slow down. So I'm thinking that within the next basically 12 to 18 months, we should be in a lot better position. And since 1929, there's been 15 recessions. So basically one every 6 years. This is not something that is just a rare occurrence. It's something that happens on a regular basis. And again, it's part of the cycles of business. There is growth, there's excessive spending, and then after a period of time, just like in our homes, we basically say we got to kind of slow down on this thing a little bit. And that's exactly what's happening right now. So what does this mean to you? Well, first and foremost, depending on whether you're retired or whether you're working and where you're working, there's a chance you could potentially lose your job, and it may be harder to find a job replacement. So the first thing I would say is always have 6 months worth of cash. Make sure that you have liquidity in your position, because when you don't, you're forced to sell your long-term assets, and it doesn't matter what the price is. So if you are in a position that you have a plan B, plan A is that you're working at your job, plan B is that if that's not happening, we have some liquidity and we have investments that are more liquid than some of our long-term investments, we are in a pretty good position. The second thing is that market investments can lose money and reduce savings and upset retirement plans. So the thing that we have to look at here, we've already had a very substantial decline in the market. I don't know if it's going to get that much worse than we have right now, but I may be wrong. I would just say make sure that you understand this is kind of how it works. As a business owner, one of the things that you may see is that you may have fewer sales. It's definitely a potential issue that people may be buying less, businesses may be buying less, they may take more of a conservative approach and not be spending at the level that they are right now. One of the things that I like to do when I talk to business owners is just see how their business prospects are and how long they see them going. And right now I feel relatively comfortable, but that may change over a period of time. And then finally, another thing that may happen is lenders may tighten standards for mortgages, car loans, and other types of financing. So again, the thing is, take a look at your credit score and make sure that you, again, have the ability to qualify for a loan. Take a look at your spending and make sure that if you are potentially borrowing money within a period of time, that you're in a position that your credit looks good and that you are attractive to lenders that are maybe tightening up some of their investment, their lending standards. Okay, looking forward, what should we be doing? Well, first and foremost, pay off any non-essential interest-bearing debt. Take a look at what is tax deductible. Again, I'm a fan of mortgages. I think there's a benefit of having a tax deductible mortgage for a long-term investment, especially if inflation is greater than the rate that you're paying right now, which it should be. But if you have large credit card debt, if you have other things, see what you can do to pay that thing down, because reasonably interest rates may rise on some of this stuff over a period of time. Take a look at potential any short-term purchases that you have over the next 2 years. First and foremost, can you push them back? Number two, can you plan for these purchases? Make sure that you have money that's liquid, that you could take advantage of potentially some of the pricing that may be a little bit better than what we've seen over the past 2 years. Review the duration of your bond portfolios. Mainly in our existing bonds, we are shorter duration, higher quality. Longer duration bonds in a rising interest rate market will take a much bigger hit than shorter duration bonds. So again, the key is short duration, higher quality. The reason for being in bonds right now is have a conservative part of your portfolio. In this type of market, take a very conservative approach. If you have a variable mortgage, think about getting a fixed. And if you have a home equity line of credit, see if you could go for some of these hybrid loans that may potentially lock in your existing loan at a fixed rate, and then still give you the ability to have some flexibility on new money coming in there. Some pretty good options that are out there. Review all your income producing investments. Again, check the quality of the investment, check the duration of the investments, make sure that it makes sense based on market conditions. I don't want to get out of larger long-term positions, but I want to make sure I understand how these things work and see if there's something different we may want to do with it. And review your portfolio periodically, not daily. I can't stress this enough. CNBC is not out there to educate you. They're out there to scare you and make you want to continue to watch. So they sell lots of advertising space. And the reason why I know that is they have shows at night that have absolutely nothing to do with investing. So when they're talking about this stuff, what keeps people glued to the TV is telling you how bad things are. Again, I think we're in a shortening of the market, or basically something that seems relatively natural. But if you look at this stuff every day, it's going to make you crazy, because it goes up, down, and it'll make you make decisions that are based more on emotion as opposed to long-term logic. So you should have received our newsletter recently, Understanding Interest Rates, which I think is very helpful. If you didn't get it, let us know and we could get you out a copy of that. And then also, I think some key takeaways we have for today is understanding inflation and interest rates is that inflation is at a 40-year high. The Fed is working to curb this by raising interest rates and using that as a brake to slow up the economy. Interest rates will continue to rise. The Fed has said that they're going to use the tools at their disposal, which is mainly increasing interest rates to slow down the inflation and the economy, which kind of makes sense. A deep recession is not guaranteed. There are a lot of people that I listen to, some say it is, some say it's not, but the bottom line is I just think this is part of a natural progression of the market. You have a lot of spending for a period of time, and at some point it starts to slow up, which we're seeing right now. The impact, I think, is going to be questionable, because I still think there's a lot of industries out there that need people and are going to continue to hire. And the most important thing I would say is focus on your personal goals and objectives. If you are in a position that you're retired, your planning should be substantially different than if you're actively at work and you feel very solid with your business. So that being said, again, a couple of things I want to kind of make sure you're aware of is that we will continue to have constant communication with you on a regular basis, whether that's through our monthly newsletters. Anytime we see a topic like this that is impacting all of us, I want to make sure we're talking about it. You understand what we're doing to help you through this. And if you have any questions, please feel free to come to our office or let's have a phone call. We are going to continue to have frequent discussions, meeting with you on a regular basis, making sure we understand your short-term needs, your long-term needs, and that we're in line with what you're trying to do with your money long-term. And then we're going to continue to have financial reviews on a systematic basis, just taking a look at where are you now, what are we doing, and are the things that we maybe want to be doing a little bit different, seeing how some of your personal situations can change. And again, I just want to say thank you. This is not my first rodeo. I've been through 2000, 9/11, 2008, March 2020, and even Black Monday. The key of these things is that these are great opportunities for new money being invested into the market on a systematic basis, not placing bets or anything. I think we need to approach this systematically. For those of you who are retired, we have planned this out in our plan. We have different buckets of money that are designed for short-term, mid-term, and long-term. So this does not impact your vacation over the summer. We've planned for this and we thought this thing through. If anybody has any questions, we're happy to speak to you. Please give us a call. Thank you very much and have a great 4th of July weekend. Enjoy, everybody.